If I saw the stock 600 down 6.5%, I would have assumed the Fed called an emergency meeting, hiked rates by 200 basis points, Greece exited, and it was almost the end of the world. It's not the stock 600, it's not the S&P 500, it's the Shanghai Comp, and it's had an epic rally. The pullback, dare I say it, a healthy one?
I think so, absolutely. It's very encouraging to see authorities doing something to calm things down, and brokers doing something on the margin side. I'm sure most EM equity desks would be very happy to see this as the beginning of the end of this enormous rally, because a lot of them went into this very slightly underweight to China, and given the enormous rally we've seen, it now means they're underperforming their benchmark by quite a way, and it's extremely uncomfortable. And if it continues, you get this style drift. You get the effect where responsible, considered, experienced managers are forced to chase this market. Nobody wants that.
How intrinsically linked is the Shanghai Composite to the Chinese economy now? This run has been going on for about 12 months. I asked that question because, sure, the brokerages have tightened up lending. They're also on the hook for a lot of cash that's in this market. If it goes wrong, they're in trouble. If it also goes wrong, there's been a huge wealth effect in the last 12 months that I'm sure to some extent has propped up the Chinese economy. What is the view on that now?
Look, I think that it's not connected to the economy in the traditional way that maybe we learned in our textbooks in our first year, that a good economy leads to good earnings, leads to a good stock market. We have seen, obviously, some easing from policymakers on the monetary side that's aimed at the economy, that I think has done more to help the market. And now that they've obviously got the wealth effect that's feeding back. Look, as your correspondent said, a massive rout might be a slight concern to policymakers, but surely a responsible policymaker in China looks at this and said, this is not healthy, and it's nothing to do with the economy, and let's calm it down a little bit.
Bear in mind that these are the same policymakers that let the property market get out of control. They did that for a reason as well. Is the equity market just the new property market in that sense?
Absolutely. I think that there's definitely these reports of people switching out of property because they see that the bull run coming to an end and moving it in, to the stock market in that manner. I think in general the property market in most economies is more important. One would hope that there's a soft landing there. There's some signs that the market has turned a little bit and is finding some stability on the property side. One hopes you can find some stability on the stock side.
Some stability on the Shanghai Composite, maybe. I'll move it from China to Japan. Chinese stocks plunging, quite a decent rally on the Nikkei. I'll bring up a chart. Dollar yen versus the Nikkei over the last 5 years. Am I still just trading the yen?
No, not really. I think there's a lot more going on in Japan than just the yen right now. But let's deal with the yen first. I think it looks like to be breaking out of this trading range it's been in for a few months. It was enormously oversold after that huge rally you see there, a huge fall in 2012 and again in early 2014. The correlation between stocks and the yen has recently broken down, even gone negative. And I think people are now concentrating on the wider story, which is reforms to corporate governance, which is the huge cash pile that Japanese companies have on their balance sheets, about 40% of market cap, if I'm not mistaken, and the possibility that that could drive enormous dividends and buybacks in the future if corporate governance continues to improve.
Monster portfolio positioning. A lot of these guys pushed out of the bond market by the Bank of Japan. You could see more of that at the back end of this year. As a foreign investor, as I see the yen declining, touching a 2002 low against the dollar, and I'm a retail investor and I want a piece of this market, what on earth do I do?
You buy it with a pound hedge share class. You take the currency out of it and you try and play the pure local currency improvement in Japanese equities. That's been a position of ours for the last few years. It remains that case. I think I have less conviction than I once did on that the yen's going that much lower, but obviously we see it moving now. If I had to bet, I think the yen is going to gradually trade down over the next couple of years. We've talked about the level of 140 potentially. I still like the fundamentals of Japanese corporate earnings, so buy the index and hedge the currency.
Buy the index and not the Shanghai Comp. Is that the view at JPMorgan Asset Management?
Well, it's certainly my view. I'd much rather build exposure to Japan than China right now.